Have you ever wondered how the multifamily real estate market in Canada is shaping up after hitting a 5-year low earlier this year? Well, there's some promising news on the horizon. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Today, we're diving into the latest insights from the Canadian real estate landscape, as reported by BNN Bloomberg. After a challenging period, real estate investment activity in Canada has shown signs of stabilization, with the multifamily residential segment leading the way in recovery. According to Keith Reading, Senior Director of Research at Morguard, the third quarter saw a modest uptick in multi-suite residential sales, fueled by improved listing supply, select investor demand, and evolving workplace trends. What's driving this recovery, you might ask? Well, it seems that lower interest rates, more listings, and better affordability are drawing investors back into the market. While national commercial property sales remain below historic highs, they have strengthened from earlier lows as buyers re-engage. Private capital continues to dominate the acquisition of apartment assets, with real estate investment trusts selectively recycling older properties. In downtown Toronto, the office market is experiencing renewed activity, bolstered by return-to-office mandates and significant trades in Vancouver. This resurgence is a positive indicator of the market's resilience, especially after the challenges posed by the pandemic. Meanwhile, the industrial sector remains robust, with healthy demand despite a slowdown in construction and stabilization in e-commerce-driven activity. Keith Reading further explains that although the market had been speculative in nature due to low borrowing costs, the recent correction has created opportunities for both consumers and investors. With more choices available in the residential market, many are getting back into the game, particularly in premium locations. Large private groups are leading the charge, alongside real estate investment trusts that are upgrading their portfolios for the long term. The office market in downtown Toronto is also seeing a bounce back, thanks to major banks and government agencies encouraging employees to return to the office more frequently. This has generated a positive momentum not seen in years, with significant trades of major office buildings adding to the optimism. On the industrial front, the market has leveled off after a period of rapid growth driven by online shopping. While the construction cycle has slowed, demand remains stable, and the availability of industrial space is still low. This stabilization offers a silver lining, ensuring a healthy balance in the market. In a significant development for the Canadian multifamily real estate market, Starlight Investments has announced the launch of a $750 million investment fund. This new fund is designed to acquire purpose-built multifamily rental properties across Canada's largest urban markets, a move that signals confidence in the sector's long-term growth potential. The initiative is backed by a substantial $415 million equity contribution from CIBC Investment Management, highlighting the strong interest and commitment from major financial players in supporting the multifamily real estate sector. This collaboration between Starlight Investments and CIBC underscores the potential for lucrative returns in the multifamily segment, especially in the context of Canada's growing urban populations and the increasing demand for rental housing. Starlight Investments, headquartered in Toronto, is leveraging its extensive experience and market knowledge to strategically target key urban areas. The move is expected to further solidify Starlight's position as a leading player in the Canadian real estate market. With urban centers like Toronto, Vancouver, and Montreal continuing to experience population growth, the demand for multifamily rental properties is poised to remain strong. This new fund represents a proactive approach to capitalize on market opportunities, ensuring that Starlight Investments is well positioned to meet the evolving needs of renters. By focusing on purpose-built rental properties, the fund aims to address the significant demand for quality rental housing in Canada's urban landscapes. It's an exciting time for investors looking to enter or expand their presence in the multifamily sector, as this fund provides a robust platform for growth. Overall, this development by Starlight Investments is a testament to the resilience and attractiveness of the multifamily real estate market in Canada. As developers and investors navigate the complexities of the current economic environment, initiatives like this offer a promising outlook for the future, reinforcing the multifamily segment as a cornerstone of urban real estate investment. As we turn our attention to Alberta, we're seeing multifamily developers navigating a market that's experiencing a slowdown. According to ranks.ca, Calgary and Edmonton enjoyed tremendous rental growth over the past few years, largely driven by stable employment, high migration rates, and favorable financing terms. However, this boom has now led to an oversupply, with vacancy rates trending upwards and rental rates stabilizing or softening. Developers in these cities are adjusting their strategies in response to the changing market conditions. With the multifamily housing market well supplied, the focus has shifted from quantity to quality, and there's a more balanced market on the horizon. The Canadian Mortgage and Housing Corporation, or CMHC, continues to play a crucial role in financing, though rising premiums and credit tightening are impacting development sentiment. The ranks.ca article highlights that while vacancy rates are expected to stabilize at or above 5% in the medium term, rental rates will likely remain muted until around 2026 or 2027. This adjustment is somewhat welcomed by residents as it alleviates rent pressures imposed by strong demand in previous years. Developers are becoming more cautious, aligning their projects with new financing strategies to navigate these shifts. At First National, developers are working with financial experts to explore a variety of strategies. Conventional financing for construction is becoming more common, while CMHC remains essential for permanent financing. Developers are also looking into high-leverage conventional land loans to facilitate land lease closings and ensure projects move forward without delay. Despite rising debt costs, opportunities for development remain on the horizon. Calgary and Edmonton still offer relative affordability compared to other Canadian cities, and high-quality, amenity-rich locations continue to be in demand. As the market evolves, developers are poised to adjust and capitalize on new and improved financing strategies, ensuring they meet the needs of Alberta's multifamily housing landscape. That's all for today's episode. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.